Alright, let's talk about your money. Investing can feel complicated, can't it? You look at the stock market, you see numbers flying around, and you wonder, what should I be doing? Many people think investing is just about picking a good company. They believe if they find a strong, profitable business, their money will grow. And yes, that is part of it. But it is not the whole story. You need to understand that you are not investing in a vacuum. You are part of a giant, worldwide game. This is where something called game theory comes in. It is a powerful way to think about your decisions when other people's choices affect your results. Now, don't let the word theory scare you. It is simpler than it sounds. Game theory is just the study of making smart choices when you are playing against others. Think about a simple game like rock, paper, scissors. Your best move depends entirely on what you think your opponent will do. If you believe they will choose rock, you should choose paper. Investing is a lot like that, but on a much bigger scale. Every time you decide to buy or sell a stock, you are playing a game against millions of other investors who are all trying to do the same thing: make their money grow. So, your success isn't just about the company you pick. It's about how your choice plays out against everyone else's. This is a truth you must accept to be a successful investor. The price of a stock does not just reflect how good a company is today. It also reflects what millions of people that company will be worth in the future. It includes their hopes, their fears, and their guesses about what everyone else is thinking. Are you starting to see it? You are not just buying a piece of a business. You are entering a game where you must anticipate the moves of other players. This is why a stock for a great company can sometimes go down, and a stock for a struggling company can sometimes go up. It is all about the collective psychology of the market. So, when you are looking at your investment account, I want you to stop and think. Ask yourself, what is the game being played here? Are people buying this stock because the company is truly innovative and profitable? Or are they buying it simply because it is popular and they expect others to keep buying it, driving the price up? Understanding this distinction is the first step to moving from being a mere speculator to becoming a true, long-term investor. It is the difference between gambling and having a powerful strategic plan for your financial future. You have to know what game you are in to have any chance of winning it. There is a famous idea in economics that explains this perfectly. It is called the Keynesian beauty contest. I know, it sounds a little silly, but stay with me. Imagine a newspaper contest where you are asked to pick the 6 prettiest faces from 100 photographs. The winner is not the person who picks the faces they personally find most attractive. No. The winner is the person whose picks are closest to the most popular choices of everyone else entering the contest. So to win, you have to ignore your own opinion and guess what the majority will find beautiful. You have to think about what other people are thinking. This is exactly what happens in the stock market every single day. Many investors are not buying a stock because they have done deep research and believe in the company's long-term value. Instead, they are buying it because they will soon think it's a good buy. They are trying to get in just before the crowd rushes in, hoping to sell it to them at a higher price. This creates a cycle where a stock's price can become disconnected from its real value. It becomes popular simply because it is popular. This is a dangerous game to play, girlfriend. It is a game of speculation, not of sound investing. Think about the meme stocks we have seen in recent years. These were often companies with weak financial foundations. But a community of online traders decided to buy them all at once. Their goal was to drive the price up and beat the professional investors who were betting against the stock. For a short time, it worked. The prices went sky high. But were those prices based on the company's true worth? Absolutely not. They were based entirely on a short-term game of guessing what the crowd would do next. And when the game ended, Many people who bought at the top were left with serious losses. This is why you must be so careful. When you see a stock soaring and everyone is talking about it, you will feel that pull. That fear of missing out, or FOMO, is a powerful emotion. You will be tempted to jump in, thinking you can ride the wave just a little bit longer. But you are not investing in the company at that point. You are trying to win a beauty contest. You are betting that you can guess the crowd's next move. That is not a strategy for building secure long-term wealth. It is a recipe for anxiety and, far too often, for financial disaster. You must be smarter than that. It is so important to understand the different types of games you can play in the market. In the short term, investing can feel like what we call a zero-sum game. Think of it like a poker game. For you to win a pot, someone else at the table has to lose their chips. The total amount of money on the table does not grow. It just moves from one player to another. Short-term trading is very similar. Day traders who buy and sell stocks within hours or days are not trying to grow with a company. They are trying to outsmart other traders, betting on tiny price movements. For them to make a profit, another trader must be on the wrong side of that same bet. This is a high-stress, high-risk game that is almost impossible for an individual investor to win consistently. You are playing against high-frequency trading computers and professional firms with massive resources. They have more information and can act faster than you ever could. Trying to beat them at their own game is like showing up to a Formula One race with your family car. You might get lucky once in a while, but over time, you are going to get left in the dust. This is why I tell people, over and over again, that day trading is not investing. It is gambling, plain and simple, and you cannot afford to gamble with your financial security. Now, let's look at the other side, long-term investing. This is a completely different game. It is what we call a positive-sum game. Instead of fighting over a fixed pot of money, everyone can win together. How? Because you are not betting against other traders. You are partnering with great companies and sharing in their growth over many years. When you buy a share of a strong, innovative company, you own a tiny piece of that business. As that company creates new products, expands into new markets, and increases its profits, the value of your piece grows. The overall economic pie gets bigger, and your slice gets bigger with it. This is the game you want to be playing. It is a game where your success is not dependent on someone else's failure. You are joining a collective effort of growth and innovation. When you invest for the long term in a diversified portfolio of good businesses, you are harnessing the power of the global economy. You are betting on human ingenuity and progress. This is a much calmer, more powerful, and more reliable way to build wealth. You are not trying to outsmart anyone. You are simply participating in the long, upward journey of the economy. This is the approved path to financial freedom. We have talked about the game against other investors, but there is another game you must master, and this one might be the hardest of all. It is the game you play against yourself. Your own emotions, fear, and greed are your biggest enemies as an investor. They will try to trick you into making terrible decisions at the worst possible times. When the market is soaring and everyone is euphoric, greed will whisper in your ear. It will tell you to abandon your plan, chase after the hottest stocks, and take on far too much risk. You will feel that FOMO we talked about, that fear of being left behind. Then when the market inevitably turns, a different emotion takes over, fear. When you see the value of your investments falling, panic will set in. Every instinct in your body will scream at you to sell everything before it goes to zero. This is how people lock in devastating losses. They buy high, driven by greed, and they sell low, driven by fear. This is the exact opposite of what you should be doing. It is a cycle of emotional decision-making that will destroy your wealth over time. Acknowledging this internal battle is the most important step towards winning the investment game. You must have a plan that is stronger than your feelings. So, what is the practical advice? First, you must have a plan before you invest a single pound. Know your goals, your time horizon, and your tolerance for risk. Write it down. This plan is your anchor in an emotional storm. When you feel the pull of greed or the panic of fear, you go back to your plan. It is your rulebook for the game. Second, you must learn to ignore sunk costs. If you made a bad investment, the money you lost is gone. Do not hold on to a losing stock, hoping it will come back. Make a decision based on its future prospects, not on your past mistakes. It is about where you are going, not where you have been. Finally, the way you truly win is by playing your own game. Stop trying to outsmart everyone else. The goal is not to have the best performing portfolio of anyone you know this year. The goal is to have a portfolio that allows you to meet your financial goals for the rest of your life. This is won through discipline, patience, and consistency. It is won by automating your investments, diversifying your holdings, and staying the course for decades. The ultimate win in investing is not beating the market. It is creating a strategy that works for you and having the discipline to stick with it, allowing you to live the life you want with security and peace of mind. That is true wealth.